The U.S. debt spiral is out of control, and it's reshaping the future of gold and silver. In this video, Andy Schectman explains why fiscal collapse isn't just theory anymore, and how it's fueling a massive shift toward real assets.
And foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there's a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government.
This part nails the foundation of today's metals bull case. The U.S. debt path isn't just unsustainable, it's accelerating. When Schectman says fiscal sanity is gone, he's pointing to why global central banks are quietly converting paper assets into real ones. Gold and silver aren't speculation anymore. They're becoming defense assets against government dysfunction.
In October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries, like in gold, that are 93% higher for the month than posted on the first day.
That's a major signal. When silver deliveries on COMEX nearly triple, it means buyers want the real metal, not just paper exposure. It's a quiet sign of stress in the system, showing institutional demand shifting from futures to physical possession. This isn't retail hype, it's structural movement beneath the market.
Talked about the two big buyers that came in and drove silver price up into the green after being down $1, and gold about halfway up, because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional, and if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has the big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20. Sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25, 25, 25, 25, stocks, bonds, short-term treasury, and gold.
This moment matters. The same institutions that once ignored or shorted gold are now allocating up to 25% into it. When Morgan Stanley and Bank of America shift strategies like this, it's not sentiment, it's preparation. They see what's coming: instability in debt markets and a global tilt toward tangible assets. This content is provided for educational and commentary purposes only. It does not constitute financial advice or investment recommendations.